In today's video, we dive deep into the ongoing situation where short sellers are trying to cover their positions, focusing on a staggering $3.6 billion routed into the dark pool and a reported 104 billion short positions. Hey, welcome to AMC Daily. If you are new to the channel, be sure to subscribe to the channel and turn on post notifications by hitting the bell, so you never miss any of our uploads and also enter our giveaway. But everyone remember, this is not a financial advice video. According to a tweet, the stock is being held around $5 to complete a certain deal. A transaction involving the exchange of 92 million shares at approximately $5.01 per share indicates that if you notice a drop afterward, it suggests the deal is concluded, and market makers are creating a new exit strategy for the shorts. We'll discuss how the price will likely rise as shorts cover their positions, while the narrative might suggest it's due to a recently completed equity deal. Let's first understand how recent actions by Adam Aron, who recently restructured debt, are connected to these events. The plan involves using shares to exchange for about $464 million worth of debt. It has been stated that this amount will be converted into approximately 92.6 million shares of the company's Class A common stock, equating to around $5.01 per share. This price point gives us a good indication of where shares might be sold. If there's a notable drop after this transaction, it likely signifies the deal's completion. This scenario aligns with the recent price stagnation and subsequent drop observed in AMC's stock, suggesting the deal might indeed be over. However, other factors could also contribute, such as collateral declines in Nvidia and the broader market, which might have pressured AMC's price downward. While we can't say for certain that this is the sole reason for the price fluctuations, it is important to consider these contributing factors. If the price begins to rise as shorts cover, it will become evident that the covering of these positions is driving the price action. We need to recognize how the routing of our buy orders into the dark pool prevents the real price discovery that investors deserve. A tweet from Biggums provides some clarity on this topic. Biggums mentions how price suppression happens when buy orders are routed through dark markets, preventing them from impacting the stock's price action. Simultaneously, a large percentage of the short volume, ranging between 50% to 70%, is sent to the tape, and enough buy orders are filled by market makers to offset the short volume and prevent a rapid decline. This process maintains an artificial equilibrium, showing that floats, or the shares available to trade, are often not representative of the actual situation. By inflating share counts in the background, market makers manipulate prices. If buy orders routed to the dark pool don't cause price increases, it's clear that the manipulation is occurring to suppress the stock price artificially. When shorts begin covering and the price rises, we can deduce the extent of the short positions. If shorts were not trapped, they wouldn't need to suppress buy orders in this way. Understanding dark pool activity is crucial. For example, a tweet from Samuel Clemens highlights that Virtu, a financial market-making firm, internalized an average of 23.4 million shares of GME daily in December 2020 and up to $2.2 billion on January 26. During that period, the firm was heavily involved in internalizing these trades, which did not hit the open market and did not positively affect the stock price. This behavior is a significant example of how firms use dark pools to manipulate and suppress prices, preventing genuine price discovery for stocks like AMC and GME. Transparency and market clarity are essential to understanding what's happening behind the scenes. We might not see $2.2 billion in GME or AMC every single day right now, but millions or even tens of millions are being routed into dark pools. Estimates suggest that up to 70 to 90% of trades could be going through these dark pools, which helps explain why AMC's stock isn't reflecting the positive impacts it should. When shorts cover their positions, the price should rise, demonstrating how this suppression strategy is unfolding in the market. Furthermore, there's a discussion regarding how Virtu Financial has disregarded pressing issues in their proposals to delist penny stocks under $1. If they genuinely aim to protect retail investors, they would advocate for transparent trade settlement before implementing any rules. For those unaware, Virtu Financial recently proposed a new rule to delist penny stocks that don't meet specific requirements. One plausible reason could be that these stocks are performing poorly in some short positions. By delisting these stocks, firms avoid having to return borrowed shares, circumventing the usual rules of engagement and giving themselves an advantageous position in a challenging market. This insight is particularly alarming when you realize that this comes from a firm that internalized $2.2 billion of GME on January 26th and $1.4 billion of GME on June 29th. Virtu's actions indicate a lack of interest in genuinely protecting retail investors, despite their claims. Instead, their behavior seems tailored to their benefit, contradicting the principles they claim to uphold. It highlights a disturbing trend where regulatory proposals are presented as protective measures for retail investors, but in reality serve to benefit these large institutions. Looking at the broader implications of the short positions, we need to comprehend why AMC's price rises when shorts cover and why these entities are so intent on routing orders into the dark pool. A tweet from McSqueezy, the cow, reveals that Citigroup, the parent company of Citibank, reported $104 billion in securities sold but not yet purchased for the period ending June 30, 2024. This is a substantial figure and could be even more significant than initially thought. To put this into perspective, Citigroup holds synthetic shares of AMC, a position identified a few years ago and still in existence today. Even though it's not a primary focus for everyone now, it's crucial to remember that such positions are ongoing and substantial. The fact that Citigroup has a short position of over $104 billion is astounding and highlights the risks these firms face when the stocks they short begin to rise. A tweet from Kristen Shaughnessy further sheds light on the matter by pointing out that Goldman Sachs is allowed to leverage 101.38 times in derivatives for every dollar of assets they hold. The Federal Reserve has had to provide special regulatory capital considerations for them, allowing Goldman Sachs this substantial leverage. To put this into context, we are talking about a company with billions of dollars in assets being granted 100x leverage. This isn't a small retail trader getting 100x leverage. It's a massive financial institution with billions at its disposal. Understanding how enormous these derivative positions are becomes clearer when you consider this 100x leverage. This explains why these institutions are extremely nervous about their positions moving in the wrong direction. They stand to lose significantly more due to their high leverage. For instance, Citibank's $104 billion in securities sold but not yet purchased might not even represent the full extent of the risk. Given the 100x leverage, the real position could be much larger than reported. This deep dive into short selling, dark pools, and market manipulation underscores the need for greater transparency and fairness in the financial markets. As we continue to explore these topics, we must remain vigilant and demand more accountability from those who operate behind the scenes to ensure that all investors receive a fair and honest chance in the market. Guys, that's all we have for you today. What is your opinion about AMC stock? Get involved and let us know in the comments down below. Thank you for watching.